the remarkable surge in silver prices, which have now surpassed $100 per ounce, a milestone that has caught the attention of both retail investors and institutional observers. This sudden rise has prompted the central question of the video: what is actually driving silver in today's market? While headlines focus on volatility and price swings, the underlying forces are more complex and layered. The speaker frames the surge as more than just a temporary spike. Silver is not simply reacting to short-term news or market hype. It is moving in response to structural pressures that are reshaping the physical and financial markets. The high price has become a signal that multiple forces, demand, institutional activity, and supply constraints are converging, creating conditions that are sustaining the rally rather than allowing it to fizzle. From the outset, the video emphasizes the need to look beyond common narratives. While mainstream commentary often attributes moves in precious metals to fear or panic, this surge requires deeper investigation. The speaker sets the stage for a detailed analysis, explaining that understanding silver's drivers is essential for both long-term holders and market participants attempting to interpret the current bull run. By positioning the question of what is actually moving silver at the center of the narrative, the introduction establishes the investigative tone of the video. It frames the discussion as an exploration of real market mechanics, rather than speculation or hype, signaling to the audience that the answers lie in both fundamental and institutional forces, working together to shape price action. The video then examines silver's recent performance in the context of broader precious metals markets. Silver has surged above $100 per ounce, reaching new all-time highs, while other metals are also experiencing significant gains. Gold is approaching $5,000 an ounce, platinum has climbed to $2,679, palladium has broken the $2,000 barrier, and rhodium is likewise increasing. This comparison highlights silver's relative strength, as it is currently outperforming many of its peers. The speaker emphasizes that silver is not moving in isolation. It is part of a larger metals rally that reflects both investor sentiment and structural market forces. The fact that silver is showing particularly strong momentum, even relative to gold, underscores the uniqueness of the current market environment. The discussion also notes the speed and scale of silver's rise. Unlike slow, incremental price movements seen in past cycles, the current surge has been rapid, forcing investors and analysts to adjust their assumptions about market dynamics. This acceleration creates both opportunity and challenges, particularly for those holding physical silver, as it intensifies questions about liquidity, supply, and institutional influence. By framing silver's performance alongside other metals, the video establishes context for understanding the market forces at play. It illustrates that while headlines may focus on a single number, the story of silver is inseparable from the broader precious metals landscape, providing a foundation for analyzing the underlying drivers that are sustaining this historic rally. The video then examines the factors commonly cited by mainstream media as driving silver's price surge. These include robust investor demand, safe haven buying in response to geopolitical uncertainty, expectations of lower interest rates, challenges in refining, and persistent supply shortages. Investor demand is highlighted as a key contributor. Even as silver reached new highs, buyers have continued to enter the market, signaling confidence in its long-term value rather than a reaction to short-term price swings. Safe haven buying, spurred by global instability and geopolitical tensions, has further amplified this demand, with investors seeking tangible assets that can preserve wealth amidst uncertainty. The discussion also emphasizes structural supply challenges. Refining bottlenecks and constrained production have limited the availability of physical silver, creating a market where demand consistently exceeds immediate supply. These limitations contribute to higher premiums and increased price sensitivity, reinforcing upward pressure. Interest rate expectations are another factor. The anticipation of lower rates reduces the opportunity cost of holding non-yielding assets like silver, making it more attractive to both retail and institutional buyers. The combination of these economic and industrial factors forms a multi-layered explanation that, while partially accurate, does not fully account for the institutional dynamics that the video identifies as the primary drivers of the current rally. By reviewing the mainstream narrative, the video prepares the audience to understand that while media explanations capture some elements of the story, they omit critical structural and institutional influences that are shaping silver's unprecedented movement. The video then introduces the role of institutional influence as a key driver behind silver's rally, highlighting forces that go beyond retail buying or media narratives. A central example is JP Morgan, whose trading activities are described as effectively squeezing China, creating pressure in the paper silver market while the nation continues to accumulate physical metal. This dynamic illustrates that institutional players are actively shaping supply and demand at a scale that dwarfs individual investors. The discussion emphasizes that other nations are also participating in strategic stockpiling of physical silver. Governments and large institutional buyers are increasing their holdings, adding another layer of sustained demand that is less visible in conventional market reporting. Unlike retail speculation, these purchases are deliberate, coordinated, and often tied to broader financial strategies, making them powerful drivers of price movement. By focusing on these forces, the video positions the current silver surge as structurally supported. Institutional buying absorbs supply, reinforces upward momentum, and limits the impact of short-term selling. Retail participants, while active, are secondary in shaping the market compared to these larger, more deliberate actions. This perspective reframes the narrative. Silver's rise is not simply a function of fear, speculation, or temporary shortages. It is the outcome of strategic, large-scale accumulation by entities with significant influence over the physical market. Understanding this institutional layer is essential to interpreting current trends and anticipating future price behavior. The video then examines the structural deficit in the silver market, highlighting that industrial demand has exceeded supply for 6 consecutive years. Unlike short-term shortages, this deficit reflects a persistent imbalance where available production cannot meet ongoing consumption needs, particularly from industrial applications. Industrial demand is diverse and growing. Silver is essential in a wide array of technologies, from electronics to solar panels and other emerging applications. This sustained consumption places constant pressure on supply, ensuring that any additional investment or stockpiling further amplifies scarcity in the market. The video emphasizes that this deficit is not a temporary fluctuation, but a long-term structural condition shaping price dynamics. By situating the rally within the context of a multi-year deficit, the discussion clarifies why silver has been more responsive than other metals to both investor and institutional activity. The structural shortage means that even modest increases in demand, whether from governments, corporations, or private buyers, can have a disproportionately large impact on price. This section reinforces the idea that the current bull run is not purely speculative. It is underpinned by real, measurable supply constraints that create a foundation for higher prices. Combined with institutional buying and strategic accumulation, the structural deficit ensures that silver is experiencing conditions conducive to sustained upward momentum rather than short-term volatility alone. The video then explores future predictions and market behavior, balancing optimism with caution. The host highlights that the bull run may continue, with silver potentially reaching $150 or even $200 per ounce, reflecting both structural deficits and continued institutional accumulation. At the same time, past market behavior suggests that volatility remains high, and temporary declines, potentially to around $50 per ounce, are possible within the year. Despite these fluctuations, the speaker emphasizes that silver's role is not primarily as a speculative investment. Its value lies in wealth preservation, providing a tangible store of value in uncertain financial environments. Price swings are framed as secondary to this broader function. Investors and holders are encouraged to view short-term corrections as part of a larger trend that continues to support silver's long-term utility. The discussion underscores that understanding silver requires both a short-term and long-term perspective. While headlines may focus on rapid gains or sudden drops, the underlying structural factors, industrial deficits, institutional accumulation, and global stockpiling, remain intact. These forces ensure that, over time, silver retains its relevance and purchasing power, even as markets experience volatility. By combining price targets, potential pullbacks, and functional value, the video provides a nuanced outlook. It reinforces that current market behavior cannot be understood solely through speculation. The drivers of silver's rally are deeper, more systemic, and rooted in a combination of supply constraints, institutional activity, and strategic accumulation. The video then analyzes the gold-to-silver ratio, highlighting its significance in understanding market dynamics. Currently, the ratio has dropped below 49, settling at approximately 48.58, a level not seen in many years. This decline indicates that silver is gaining value relative to gold at an accelerated pace, signaling a shift in market sentiment and resource allocation. The speaker explains that the gold-to-silver ratio serves as a historical benchmark for assessing relative valuations between the two metals. A lower ratio often signals that silver is becoming more expensive relative to gold, which can attract attention from investors seeking comparative opportunity. In the current context, the ratio's decline reflects both strong physical demand for silver and the structural pressures previously outlined, including institutional buying and industrial deficits. This section ties silver's performance to broader precious metals trends, illustrating how movements in one metal can provide insight into the behavior of the other. By connecting the ratio to ongoing supply and demand dynamics, the video emphasizes that silver's surge is not isolated. It is part of a coordinated shift in the relative value of these key stores of wealth. The discussion concludes by framing the gold-to-silver ratio as a tool for understanding both historical context and present market conditions. Its current level reinforces the narrative that silver is experiencing extraordinary upward momentum, supported by multiple structural, institutional, and industrial drivers rather than mere speculation. This final section synthesizes the discussion, reinforcing that silver's current rally is driven by a combination of structural deficits, institutional activity, and strategic accumulation, rather than short-term speculation or media narratives. The video emphasizes that understanding these forces is critical for anyone holding or considering silver in today's market. The host reiterates that industrial demand has outpaced supply for 6 consecutive years, creating a persistent structural deficit. Institutional influence, such as JP Morgan's trading actions and global stockpiling by nations like China, further amplifies upward pressure. These coordinated forces make the market more resilient to short-term selling and highlight that the current surge is underpinned by real, measurable drivers. Future predictions are framed in this context. While prices may fluctuate, with potential highs of $150 to $200 and temporary drops to $50 per ounce, the long-term trajectory remains upward. The gold-to-silver ratio, now below 49, reinforces silver's relative strength compared to gold, signaling ongoing market rebalancing and renewed investor focus. Finally, the video emphasizes silver's broader function, a long-term wealth preserver rather than a speculative investment. By combining institutional insights, market mechanics, and historical context, the video presents a comprehensive explanation for what is actually moving silver right now. It concludes by encouraging holders to understand the depth of these dynamics, positioning them to navigate the market with informed perspective rather than reactive behavior.